we have seen the BSE 200 earnings fall by more than 2%. Initially, these cuts were only for FY25, this fiscal year. We are now starting to see cuts to FY26 as well. So this is clearly a very widespread slowdown. So once you lose momentum, a lot of people then pull back and say, boss, I was just about to invest in this factory, but what if there is a problem? If we are too late in reviving this growth, maybe some of those people would have pulled back, and then instead of 7, we'll settle at 6.5. So that's a call that is harder to take at this stage. If suppose we do descend into a trade war, so as of now it is a threat. It seems that China has already sent emissaries to the US, right? Because see, as Atalji had once said, when that Operation Parakram had happened, that लड़ाई शुरू करना आसान है, खत्म करना मुश्किल होता है.
The global economy over the past many years has been in a spot of bother. India has been the one shining light in this ecosystem. However, there are clear signs of a sharp slowdown in the Indian economy in the last few months. Is this cyclical? Is this structural? What has caused this slowdown? And what can we expect going forward? In today's episode, we discuss these topics. Joining me today is Neelkant Mishra. Neelkant is the Chief Economist at Axis Bank. He is the chairman of UIDAI, and he is part of the Prime Minister's Economic Advisory Council. He's a very well-known figure. Neelkant, thanks a lot for joining us today.
Good to be back.
And look forward to this conversation.
Yep.
So to start with, Neelkant, I want to reference a couple of discussions we did in the past. One was a long time back when we spoke about India as the bird of gold. And this was, I think, nine months odd back, when the world was looking in a really dire spot and India was looking in a great spot actually, from macroeconomic perspective, demographic perspective, and so on and so forth. And then the second episode I want to refer to is the last conversation actually you and I did, which was about 6-8 weeks back, when we spoke about how deposit slowdown and monetary tightening seems to be starting to impact growth in the country, along with obviously a slowdown in government spending. So now, sorry for the long preamble, but I had two questions. First question is, what's happening? Like, is there a slowdown? Can you kind of just exemplify that around what is right now happening in India?
So there is a very visible slowdown.
Right.
And you can see various signs of that. So everything from cement volume growth to auto sales, both four-wheelers, two-wheelers, commercial vehicles, consumer goods, and credit growth, we have seen a very sharp decline in system credit growth. There is significant rise in non-performing assets at the retail level. Many microfinance, small businesses are really struggling. And you can see that the steady upgrades to India's growth forecasts are now turning into downgrades. It's not just that we saw the 5% odd growth accelerate to 7% odd growth in consensus numbers, and then it stagnates there because India is not accelerating anymore, but it kind of is topping over, and now we are starting to see cuts. We are starting to see earnings projections cuts in the stock market. So just in the first 20 odd days of this earnings season, generally lasts about 30-35 days, we have seen the BSE 200 earnings fall by more than 2%. Initially, these cuts were only for FY25, this fiscal year. We are now starting to see cuts to FY26 as well.
Right.
That people are now bringing down estimates for the next year as well. So this is clearly a very widespread slowdown. And as you mentioned early on, the reasons are, in my view, very clear. I mean, there is a global export problem, but I think the deeper issues are all internal. So, and when you see these signs, it's like, when water recedes, it recedes from, the shallow areas first.
Right.
And so when you see retail credit, MSME credit, microfinance, they start to struggle, you know that this is a fiscal and monetary problem, that there is some contraction that has happened, which I think was mostly unintended. I think most people just took the eye off the ball. And therefore, it should be cyclical, meaning that once we address some of these issues, we should see the growth coming back.
Right. So clearly there is a growth slowdown. This slowdown is maybe 4-5 months, is old.
I think we started slowing around March, April.
Yeah.
We are now in the 6th or 7th month. And my sense is that we've kind of hit the bottom, meaning things are not worsening anymore.
Right.
And as government spending is now hitting the economy and the RBI's end of quantitative tightening, so we called it in late August when we last had the conversation that by keeping, so what we discussed then was that overnight liquidity was kept in surplus for a long time. And now this started showing up in deposit growth peaking. So as these things play out, I think by maybe Feb, March, we should start to see the economy, the high frequency indicators improving meaningfully from here.
Right. So we'll cover the kind of the recovery and potential risk to that as well. But let's first spend some time on what, in your mind, caused the slowdown when things were all looking great. So what were maybe one or two reasons that, in your mind, kind of caused this slowdown?
So there are fiscal reasons and monetary reasons.
Right.
And we've often discussed on our open dialogue chats that there are structural growth trends and you can manage cyclicality through fiscal and monetary tools.
Right.
Now, if you increase your fiscal deficit, it boosts growth. If you reduce your fiscal deficit, it takes away from growth. So India is still consolidating fiscally. So the state government deficits, I think, will be flattish or maybe marginally up or down. But the central government deficit is expected to fall from 5.6% to 4.9%. So this is the same pace of consolidation that we saw, or similar pace of consolidation as we saw the previous year, where it fell from 6.4 to 5.6. So 70, 80 basis points, I think the economy has enough cyclical momentum that it can absorb. But what happened because of the elections is that after, I think, late February, when the Model Code of Conduct came in, the cabinet meeting stopped. So the file stopped moving. And then for the next 3 months, there was no government because the elections were going on. And then it takes about a month for the ministerial positions to be announced. The ministers come in and then they start pushing their agenda. So there is a 4-5 month lull where the files didn't move. So when the files start moving, then the expenditure starts happening. So that's one reason. I think there is a second factor, which is that in some of the critical ministerial, like bureaucratic positions, there were personnel changes. So it's like, new batsman on the pitch, pitch ka jaiza le raha hai ki how the files move, which is important, what is not. Generally, officers are very capable of, because they're used to getting transferred and adapting to new situations, but still takes a couple of weeks, couple of months. On top of that, there were some, I think, buffers which were, I think, kept in the budget in anticipation that some new spending programs will come, which we haven't seen so far. And therefore, I think concerns arose that the spending may not happen. What has also happened is that direct tax collection is doing better than expected. Even if the government was spending as much as it wanted to, if the direct tax collection is doing better, then basically the pace of consolidation is faster than it thought. So I think the government is now wiser to this. So basically over the last month and a half or so, I think sufficient feedback has gone to the government, the finance ministry, that we need to accelerate the pace of spending. And we saw just yesterday, like early November, the finance ministry officials making explicit comments that we will meet our spending targets this year.
Right.
So, which means that in the first 5 months, central government capex was down 19% year on year. In the month of September, which is the 6th month, it was down 2% year on year. So, it is not up yet, and the full year number is supposed to be up 11%. So, which means that in the second half, if they really meet their capex targets, you're going to see 30-35% growth in the spending. So last year's growth was front-loaded. This year's growth is back-loaded. The spending is back-loaded. So those are factors. At the state level, similar things happened. So at the state level as well, because elections, the file movement stalled, and states generally have weaker bureaucracies. The response function, it's like, in a good car, you move the gear, the car starts moving, right? In some of the worse cars, you move it and then you press on the pedal and 5 seconds later, the thing. So state governments are somewhat like that. It takes longer for them to respond. There was less uncertainty because of government change, but that's offset by the slower response function. But it is reasonable to expect that momentum is also now coming back into line. So one should expect that at least on the fiscal side, things should improve.
So on this point, Nilkant, firstly, one kind of correlation or causation you are implying is that government spending is a direct influencer of economic growth. So as an example, we didn't speak about what's happening to corporates or individuals, etc. But in this case, the government spending was a direct. And I guess that is because when the government spends, that money goes to private hands.
No, it's not just that. It is, I get the question. And I think it's a very important question. Like, if the economy is doing so well, why do we need the government to spend so much?
Right.
And which is where I said that, look, there is a certain pace of fiscal consolidation that you're used to. So if you look at a 70 basis point consolidation over the course of the year, general government spending, I think the cyclical momentum is strong enough for us to absorb that. The problem is that if you look at 12-month spending, the spending from August 23 to July 24 versus August 22 to July 23. So if you take 12-month periods of spending, the gap was 3% of GDP. Because see, the government is a very large entity.
Right.
Government spending, central government spending is about 48-50 lakh crores, 50 trillion rupees, right? So it is almost 16-17% of GDP. There's no other entity which spends so much. Now, if government spending is following a predictable trajectory, you can ignore it. It is a force of nature which is predictable. If you see a disruption of this scale, where your full year expenditure or full year deficit is going to drop by 70 basis points, 0.7%, but you actually see a run rate fall of 3% point, it will show up in growth number. It is almost like, and this is an example I love to make, that in a fish tank, you have those bubbles rising which give oxygen. So I often get questions from investors, why is urban consumption slowing? This is after we do the fiscal and monetary, and we'll discuss the monetary side as well, because that's also a very important contributor to this slowdown. So why is urban consumption slowing? So look, urban consumption slowing is a manifestation of the slowdown. It's like when the power goes off in the fish tank and those the bubbles stop, and then oxygen levels start dropping and the fish start slowing down. And then you inject that again, and then so there are so many cyclical factors, so many steps through which the government spending affects the economy, that it's perhaps impossible to pinpoint the point at which the government spending has driven the slowdown. It's so large and so diffuse that, and especially because the state governments are involved as well. You just have to track the macro numbers, and it's not surprising that I think October spending has been very strong. I mean, we will see the data in next maybe 2-3 weeks, but from what I gather from the chatter, it is picked up meaningfully in October, and which is therefore it's not surprising that we are starting to see kind of a bottom in the expectations and the momentum.
Great. So we spoke about the fiscal side. You also refer to the monetary side. So what happened on the monetary side?
So monetary side, we discussed the last time on that how loans create deposits, and that the RBI's share of money creation had slowed down very sharply. My understanding is that the RBI, started believing, or perhaps still believes in, that theory that you don't really need to look at the quantity of money, that you just look at the cost of money, and the quantity of money kind of takes care of itself. So I have a bit of disagreement with that view. It might work in developed society, developed economies, because they're kind of pushing on a string with quantitative easing, and there's a surplus amount of funds in the system, and therefore you don't really bother about what is M2 growth and whatever. But in an economy with high interest rates and growing at 11%, 12% nominal GDP, I think you need to be very careful about how much money is being created. So the first step was that the RBI injected money was not enough. For a while, money availability or the growth in money availability was not a problem because the banks were lending rapidly and therefore creating enough money for the system. But around March, April, when I think the banks were slapped on the wrist for having very high loan deposit ratios, the message that the banks took was that the regulator wants us to slow down lending. And as you can imagine, so as they slowed down lending, deposit creation slowed, and then so in like 4-5 months, we've gone from 17% growth to 12% growth. And when you see such a strong negative credit impulse, obviously the economy will slow down. And this is again one of those diffuse things where at the margin you are starting to see, because the weaker hands, the smaller businesses, they are starting to struggle for liquidity, and then everything starts to slow down. So we have seen, in fact, real estate I think is in a very strong upcycle, but in the first half, real estate sales in the major cities have actually declined.
Right.
There are some tier 2 cities, I'm told, like Indore, for example, is really struggling already. So therefore, it's very important for the monetary side to start easing as well. And as I mentioned earlier, the overnight liquidity surpluses have now started to become deposits. Deposit growth is picking up. And remember, deposit growth is picking up even as credit growth is slowing down, which means that RBI injected money is now really flooding back into the system. And as the banks start to feel the relief that liabilities are no longer a problem, and loan deposit ratios are coming down. Private banks in the September quarter saw, I think, 15-16% credit growth, 12-13% credit growth, and deposit growth was 15.5%.
15%, yeah.
So as that starts to happen, I think in a couple of months, you will see banks becoming comfortable with lending again. And as the credit impulse then picks up, then I think the economy sees a cyclical revival.
Right. So again, kind of going back to, I think we discussed this in the last conversation as well, when the money supply in the economy goes down, the economy starts to slow, just because there is not enough money
feed the fish.
Oxygen to feed the fish in your example. And what has happened over the last, I would say, many months actually, almost 30 months, is that RBI had kept the liquidity in deficit. And so basically money was going out of the system through that mechanism. And hence deposit growth was for a long period actually lagging credit growth. And that has peaked now and it's kind of reversing itself. Yeah. And we are now seeing stronger deposit growth, which should, in your words, give confidence to the banks to lend more. As they lend more, deposit growth should also grow. At the same time, the impulse to the economy will mean that...
So money supply, the money availability improves.
Yeah.
And then the improving credit impulse, actually, then there's like, it's like, in a parched earth, you throw some water in and things start to revive again.
So if you put all of this together, Nilkant, which is the fiscal side and the monetary side, it seems like both the quote-unquote negative, unintentionally negative impact of both came at the same time and jointly have created the issue. But both seem to be unraveling and hence, in your own words, it should come back to a growth path. Back, let's say in a few months, we should again look as if we are kind of back to growth. Now, there are obviously other risks and there are both risks upside and risks downside. So we could come back, we were at let's say 7% growth. We could come back to 7, we could be 6.5, we could be 7 and 7 plus whatever, right? So what are these? What are factors that could influence the growth story of the country?
Yeah, so there are so many, that's a great question. And I think it's important to see the changing global macroeconomic environment.
Right.
And what has happened in the last 2 months since September is that the 10-year US bond yields, which effectively determine the global cost of capital, have risen from 3.6% to 4.4%. So there's almost like an 80 basis point increase, which is substantial.
Very substantial, yeah.
And that, not surprisingly, has resulted in almost an incessant outflow of funds from India. Capital from India. So equity capital outflows, which somehow, because it kind of coincided with the economic slowdown, people thought it was foreigners dumping India because of India-specific reasons. But if you compare it to what is happening in other emerging economies, it seems to be an EM sell-off. It is not really an India-specific sell-off. India, because it's a much larger market now, so, $10-11 billion, for most market people who have been around, who have gray hair, seems like a very large number. But when you compare it to percentage of market cap, it's 0.2%. So 0.2%, we have seen several times. In the last decade, we have seen, 4 or 5 times that this has happened. So it is unprecedented in absolute terms, but it is not. So, and with Trump's election and the fact that he has fiscal policies, or he has promised fiscal policies, which can potentially increase US government debt by 20%. We think that higher bond yields will reduce those inclinations, because if it costs a lot, then you'll be more prudent with it.
Yeah.
So then, but still, it can raise inflation expectations by 1.25%, including the tariff, the import tariff increases that they're promising, which means that the global cost of capital could remain elevated. There are many other things that he promises to do, but if you reducing the size of the government, deregulation, which are all going to be positive for US growth. But I think that the impact of those may come up, 2 years,
gradually.
3 years later. Yeah. But initially, I think the cost of... So if EMs, continue to see outflows, then it kind of ties India down as well, right? So that's one of the issues. And if it causes something to break somewhere, because remember that we have seen weak growth for a while, and there are many vulnerable countries. We have $600+ billion, we have negative forward positions now, but if we adjust for that, we still have $600 billion plus of reserves, which is a lot. We should be able to, tide through this, what should be a several weeks or months of outflows. But there are weaker economies which can then start to struggle. That could create other cascading effects. So China is still not out of the woods. They tried to do some fiscal interventions, which is just removing the fiscal fudge. Basically, what was off balance sheet. The headline number of 10 trillion RMB looks very large, but it's just off balance sheet to on balance sheet. And their reluctance to do more of consumption stimulus tells you how politically difficult it is for them to execute it. That can be another problem, that if China slows further, China goes into deflation. If you look at Chinese inflation, problem is that adjusted for vegetables and pork, which are very volatile food items like India's, they are already in deflation.
Right.
And if pork prices fall, which they will, because they are soya and corn imports are rising, and soya and corn imports today, 6 months later, pork, right? So the pigs will eat it, and again, people will eat the meat, which means that you are actually playing with deflation now, and that's very dangerous for any economy. And then it can cause effects which perhaps the government may find hard to manage. So I think there are several other risks which can sort of change the environment and therefore our growth expectation. There are positive things as well. So if the Chinese regime figures out that under the Trump administration they will be badly disrupted and throws a lot of money into the ecosystem, and it kind of forces them to take the political decisions which are currently hard. See, sometimes to get the right decision in, you need to get a shock.
Right.
Now, if they start doing the right thing, then the global economy then starts taking off again. So those are the uncertainties we would watch for. But at this stage, I think it is reasonable to think that if nothing else changes, we should be getting back to the, maybe not 7% fully, but maybe a 6.5% range. And if we are not too late, see, one of the things that I want to wait for before I sort of put out my prognosis is once you lose momentum, the economic momentum kind of feeds on itself.
Yep.
So once you lose momentum, a lot of people then pull back and say, boss, I was just about to invest in this factory, but what if there is a problem? Now, if we are too late in reviving this growth, maybe some of those people would have pulled back, and then instead of 7, we'll settle at 6.5. So that's a call that is harder to take at this stage.
Understood. So if I kind of summarize everything you said, we have some external risks. Most significant, I guess, is global interest rates rising because of what's happening in the US, tax cuts, tariffs, more spending, higher deficits, and so on and so forth. And higher interest rate in the US means that people pull money out of India and other emerging markets, but India for us, and take it back to the US because there are better yields there versus, so why, if you're getting 5% in the US, why would you invest in, like lesser people would invest in India, you would put more in the US versus if you are getting 3 or 2 or 0% there.
Correct.
So that is one risk, that capital goes out. As capital goes out, then, it causes subsequent issues. There are currency issues and so on and so forth. And hence that could dampen our growth going forward. There could be issues in China which could kind of contagion effect come and impact us. There could also be, I guess, like a lot of what the Trump administration is talking about, tariffs and all, will have second, third order implications on global trade itself, like supply chains and how they work and so on and so forth. And I presume that could also have a...
Oh yeah, so that is another uncertainty. I'm glad you brought it up. That if suppose we do descend into a trade war.
Right.
So as of now, it is a threat.
Right.
From what you gather from Twitter and various podcasters like us, it seems that China has already sent emissaries to the US, right? Because see, as Atalji had once said, when that Operation Parakram had happened, that ladai shuru karna aasan hai, khatam karna mushkil hota hai. Right? So it's very hard to end a war. So once the US has fired the salvo of say 60% import duty, which is what he has threatened, then China has no other response than to retaliate, which is we devalue the RMB, put retaliatory options, and things become then very complicated. So it is better to diffuse the situation right up front. Suppose that doesn't work, and given the choice of officials that Trump's administration is as of now proposing, looks like it will not work. I mean, that there will be disruption. Now, suppose you put a 60% import duty on all Chinese imports. Now what happens? Suddenly, the flow of trade shifts. So some ports will see a lot of volume, some ports will not see a lot of volume. The way the ships are routed, the way the container movement happens, and then suddenly freight rates start moving up. And when freight rates, then it's like sand in the wheels of global trade. And that causes massive disruption in global trade. If China retaliates by devaluing the currency, then suddenly every country has to take a hard call. So as of now, I think the RBI is focusing on its mandate and keeping the currency less volatile. But if the RMB suddenly depreciates by 10%, I mean, the RBI's hands can be forced. And that of many other economies will be forced. So then we are headed into a period of significant uncertainty. In fact, there's a nice Twitter thread, which I'm hoping is not going to play out, but it can, is they quote this interview that Henry Kissinger had with Ed Luce of the FT, where they talk about, or Kissinger hints that Donald Trump could be the person who was needed to break a system which doesn't work anymore.
Right.
So when a system doesn't work anymore, and there are so many interconnected factors that it's very hard to break the system or just modify the system. You just have to break it apart. And maybe you need a person like Trump to come in and challenge everything, right? The size of the US government, the NATO's presence in Europe. Does it need to be involved there versus the US people are spending more money on the US? How should you deal with China? Because there's so many interdependencies. And once all of those basic assumptions under which the world was running start to get questioned, you are heading into a new world order. And when the new world order is being set, it's like, if you remember 2016 or 15 to 18, 19 in India, forget before COVID. I mean, even before COVID, I used to call it India house under renovation. That you're setting up GST, you've gone through RERA, you've gone through demonetization. A lot of big disruptions were happening. Now, as a result of those, we settled down much better. And then all the NPA cleanup was happening, IBC was being put in place. If we go through that phase for global growth, imagine the level of uncertainty and what it does to markets and the economies. So for all you know, maybe that's what's ahead of us in the next 12 months.
Understood. Great. So Neelkant, now we spoke about the short term, we spoke about a little bit the medium term. What is, in your mind, all of this, how does this play into, let's say, a 5 or a 10-year view, if you were to kind of look forward in terms of where we are and hence what to look out for and what to do or what not to do?
What you have to do depends on who you are, meaning that, I'm not trying to be deeply philosophical here. I'm just saying that, if you're a policy maker, you have to act differently. If you're a banker, you have to act differently. If you're an investor, you act differently. A producer, you act differently. So, see, the old frameworks that we have used, there is a labor input, there is capital input, and there is total factor productivity. I think we have to keep improving our total factor productivity. And
right.
For that means that we have to continue to invest in infrastructure. We have to continue to innovate. All the things that we were wanting to do, we have to keep doing. OCEN and ONDC and how to get capital to grassroots, spread it widely so that inequality doesn't rise, and focus on all the factors that drive capital formation. Just like today, one large industrials company said that they've got a massive order from one of the largest thermal power companies in India. So because all those power plants need to be constructed, and when that construction, the announcement of the construction does nothing to the economy, but the construction of that power plant, where say $3-4 billion will be spent, means that much of steel, that much of cement, that much of truck movement, crane movement, labor employment. Cyclically, I think we are in the right place, but we need to manage that cycle in the sense that if the real estate cycle is on an upswing, people want bigger houses, better houses, and are willing to pay for it because their houses are more affordable than they were. We need to increase the supply of that. So if we manage, so as policymakers, if we realize that a large part of our demand is going to be internal, and this is a point that I repeatedly make, that as much as we prioritize our export markets, or that India should grow its net export, which it should. I don't think it's going to be possible to grow massively without exports. But remember that the biggest manufacturer the world has ever seen, which is China, as a percentage of global manufacturing, it is bigger than what the US was at its peak, the UK was at its peak. Even today, rolling 12 months of goods net exports are 5% of their GDP. Right? So 95% is all domestic demand generation, right?
Yep.
And we have to think similarly. So even as we open up, and opening up the channel through which it affects us is productivity. I can give you examples of how that works out, but so it will improve our productivity, but we have to focus on internal demand. So as policymakers, I think we need to look at how we can accelerate urban infrastructure development, how we can accelerate a volume-driven real estate cycle, and ease access to finance for large segments of the population. Many structural reforms that we need to do. Business people, I think there are lots of opportunities that emerge, and so different people can act in different ways. So the 5-10 year growth for me, given that we will still have the youngest population, we will still have AI and technology and all of these changes which will affect our growth positively. And if our capital formation cycle continues, I don't think 7% growth sustained over the next 5 years is still a challenge.
Fantastic, Neelkant. Fantastic conversation.
Thank you.
Just to kind of pull all of this together, there is, while India has been on a structural growth path, in the last 5-6 months, we've seen a marked slowdown in the economy, which is driven by two factors. One is the kind of slowdown in government spending due to elections and all the other issues. And the second one is liquidity tightening by the central bank, which has resulted in just not so much money being available in the economy. These two factors have unfortunately coincided at the same time and have created this situation. But also these two factors are now unraveling at a rapid pace. Government spending is already quite significantly back up, and feels like over the next 4-5 months they will catch up on all the deficit that existed in the previous 6-7 months. On the monetary side, liquidity is already in surplus since June, so it's already been 3-4 months in surplus, and that seems to be now percolating into the banking system as evidenced by deposit growth. So even that should come back. So the short-term factors have obviously reversed. One question is whether they've reversed quickly enough and have they left some residual impact or not, which we will only see over time. There are some external risks to growth, particularly what happens in the US and do global interest rates rise, which could result in some outflow of capital. Also, some events in China could cause contagion effect and create issues for us. But otherwise, if these things, don't kind of happen or don't happen at a very rapid or a large scale, India seems poised to kind of come back to the growth trajectory. Over a 5-10 year period, things continue to look positive for India, provided we continue to do the right things and we don't create problems for ourselves.
Or become complacent. See, if you have to drive the car at 80 kilometers an hour, you have to be alert and be solving problems continuously. Driving at 20 kilometers is very easy.
Right.
But you need to be driving faster and therefore be alert and not become complacent.
Right. Great. Thanks a lot, Neelkanth, for your time and for this conversation.
Thank you.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.